Assalamualaikum. So today I will explain about liquidity and I will use current ratio to explain all the company. So on the fourth on the list, we got four company that has a 1/1 ratio. So the four of it is Time.com Berhad, Telekom Malaysia Berhad, Media Prima Berhad, and Astro Malaysia Holdings Berhad. Time.com Berhad has 3.45, Telekom Malaysia Berhad has 1.52, Media Prima Berhad has 1.43, and Astro Malaysia Holdings Berhad has 1.16. This means all these four company has a very good current ratio, which mean, for example, for Time.com Berhad, for every ringgit they owe in short term, they have 3.45 ringgit in short-term assets such as cash to pay the debt. This show this for company has a good uh, management, especially in managing the asset. While the other three that are Axiata Berhad, Celcom Digi Berhad, and Maxis Berhad, they have the current ratio below 1. Axiata Berhad has 0.64, Celcom Berhad, Celcom Digi Berhad has 0.56, while Maxis Berhad has 0.18. This means that these three company has a hard uh, time to pay short-term debt, especially to pay the unexpected expenses.
Okay, next we will continue with the long-term solvency, which we will use the debt ratio approach. Alright, in 2024, the debt ratio comparison across the seven companies reveals a significant range in financial safety and risk. Time.com Berhad stands out as the most financially secure with a very low debt ratio of 21.4%, continuing its strong 10 years net cash position. Telekom Malaysia Berhad that have debt ratio of 51% and Media Prima Berhad that have debt ratio of 52% follow as safe choices with conservative debt levels and solid cash reserve. Celcom DG Berhad maintains a steady and manageable position at a 55% debt ratio, which has remained consistent for 2 years and is supported by its large market share. On the higher end, Axiata Group Berhad with debt ratio of 62% and Maxis Berhad that have debt ratio of 73% carry more debt to fund massive infrastructure investments like 5G commitments, though Axiata Group Berhad is actively working to reduce its borrowing. Okay, finally, Astro Malaysia Berhad is the most financially strained with the highest debt ratio of 81%, making the company more vulnerable to industry changes than the other company.
Assalamualaikum and good afternoon everyone. My name is Umi Maisara binti Muhammad Zubair and my matrix number is 312259. Today I will be explaining the efficiency analysis of several companies based on assets turnover ratios. Efficiency refers to how well a company uses its assets to generate revenue. In general, a higher asset turnover ratio indicates better efficiency because it shows that the company is able to generate more sales from its asset. Firstly, Media Prima recorded the highest total asset turnover ratio at 0.59. This indicates that Media Prima is the most efficient among the companies in using its total assets to generate revenue. In simple terms, for every ringgit invested in the assets, Media Prima is able to generate more sales compared to the other companies. This suggests that Media Prima manages its resources well and focuses on maximize the use of existing assets rather than over investing in the new ones. One possible reason for Media Prima high efficiency is that it operates in the media industry where content can be distributed across multiple platforms without requiring very high additional asset investment. As a result, the company can generate higher revenue using relatively fewer assets. Next, Astro recorded an extremely high fixed assets turnover ratio. This shows that Astro uses its fixed assets such as broadcasting equipment, studios, and transmission infrastructure very efficiently. Fixed assets are usually expensive and require high maintenance costs, but Astro is able to generate strong revenue from this asset. This may due to the Astro's wide subscriber base and effective use of its broadcasting facilities. By fully utilizing its infrastructure, Astro can spread the cost of fixed assets over a large amount of revenue, which improves efficiency. However, not all companies demonstrate the same level of efficiency. Companies such as Axiata and Time.com recorded a lower asset turnover ratio. This indicates that these companies are less efficient in using their assets to generate their sales. One possible reason is that these companies have heavy investment in infrastructure such as network equipment, technology, and telecommunication system. A company has a large amount of asset, but revenue does not increase at the same rate, the asset turnover ratio will be lower, and this may also suggest underutilization of asset ratio will be lower. However, it is important to note that the lower efficiency does not necessarily mean poor performance, as these companies may investing long-term growth.
For Celcom Digi Berhad is 10.96% indicates that the company has increased operating costs resulting decreased percentage of profit margin, while ROA for Celcom Digi Berhad is 3.86% indicates that the company abilities to generate profit from assets has been decreased. Profit margin for Maxis Berhad is 0.13% indicates that the company became more profitable, while ROA for Maxis Berhad is 0.06%, show that Maxis Berhad uses its assets more efficiently. Profit margin for Telekom Malaysia is 17.22% indicates that the company generate more profit, while ROA for Telekom Malaysia is 9.53% indicates that company has gotten better at turning assets into real earning. Next, profit margin for Axiata is 7.16%, showing that the company has successfully managed to bring itself from loss ratio, while ROA for Axiata is 2.15%, show that company ability to generate profit. Profit margin for Time.com Berhad is 22.81%, while ROA is 7.65%, indicates that both has shows consistent and healthy profitability. Profit margin and ROA for Media Prima is 7.18% and 4.21% indicates that the company has in healthy profitability. Profit margin for Astro is decreased to 0.83%, indicate that the firm experienced huge loss relative while ROA is showing growth, which is 0.49%.
So now I will continue to present the market value analysis for the companies in telecommunication and media industry. The market value ratio used in the analysis are PE ratio and PEG ratio. Firstly, Telekom Malaysia showed a moderate PE ratio and stable PEG ratio indicating balanced market valuation, stable growth potential, and lower investment risk. Next, Celcom Digi. As we can see, Celcom Digi have high PE ratio, showing that investors have strong expectations towards the company growth, although the shares may be considered more expensive. Next, Maxis showed Weaker market value performance due to lower profitability, which reduce the attractiveness to investors. Axiata Group recorded moderate market valuation and average growth performance compared to the other company. In addition, Time.com recorded the highest PE ratio among all the companies analyzed, reflecting reflecting the strong investor confidence and high growth expectation. However, the company's shares may be considered highly valued and riskier for investors. Astro Malaysia Holdings showed good profitability and strong earnings performance, but as we can see, its high debt level may increase financial risk. Lastly, Media Prima recorded the lowest PE ratio and PEG ratio, indicating that the company may be undervalued and has potential future growth opportunities. Overall, Telekom Malaysia is considered the best investment choice because it demonstrated balanced market valuation, stable profitability, and lower financial risk compared.
Assalamualaikum. Hi, my name is Muhammad Firdaus bin Izan. I want to present about the best investment for among our company. Okay, the best investment for company is Telekom Malaysia. Okay, today I will explain why Telekom Malaysia Berhad is considered one of the best investment. First, TM demonstrate strong financial performance in 2023. The company recorded revenue of 12.26 billion ringgit and profit attributable to shareholders of 1.87 billion. This shows that the company continue to generate stable income and improve profitability despite market competition. Second, TM has a strong financial position. Shareholders' equity increased to 9.16 billion ringgit, while total borrowing decreased to 4.76 billion ringgit. The debt equity ratio also improved to 0.8, showing lower financial risk and better financial stability. And third, TM continue to experience growth in broadband and digital services. Unify remain the largest revenue contributor and broadband subscribe increased to 3.13 million customer nationwide. The company also expand cloud computing, data center and digital solution services. Next, TM show effective cost and cash management. Operating costs were reduced in 2024. Cash balances increased and finance costs become lower because the company actively repaid borrowing yearly. This improved the company liquidity and operational efficiency. Lastly, TM has strong future growth opportunity through 5G technology and computing artificial intelligence and smart city project. Since internet and digital services are always in demand, TM has strong long-term growth potential. In conclusion, TM is a strong investment choice because of its stable financial performance, lower debt, strong digital business growth, and future expansion opportunity. That's all from me. Thank you.
Next, I will tell you why we not choose other companies for investment. First, Astro Malaysia Holdings Berhad has high debt and weak liquidity. This increases financial risk because Astro relies heavily on borrow fund. Next is Media Prime Berhad. Media Prime Berhad has lower profitability compared to Telekom Malaysia. Lower profits may affect the company's future growth potential. Besides that, Time.com has high debt and expensive market valuation, making it riskier for investors. Moving on to CelcomDigi Berhad, this company show liquidity weak performance. This means CelcomDigi may face difficulties in handling short-term financial obligations. Meanwhile, Maxis Berhad record low profitability and has weak liquidity ratio. This indicates weaker financial performance compared to the other company in the same industry. Lastly, Axiata Group Berhad show low profitability and poor efficiency in using its asset to generate sales and revenue. In conclusion, although these companies have their own strengths, they also face several weaknesses and risks. Compared to the other companies, Telekom Malaysia has shown more balanced and stable financial performance, making it a better company to investment choice.